Good evening, everybody. Stanley here from learnwithstanley.com, and welcome to our Premium Club webinar number 26. This is a webinar that we'll be doing every bi-weekly. Every 2 weeks, we'll hold a webinar for our Premium Club members and also for my iFast clients. And what we do is we basically deep dive into some of the research that I've been doing, or I'll be sharing some of my investment philosophy or strategy that I've used over the past 20 years and how it could benefit you as well. And you could use it as a reference. So today we're gonna deep dive into Nike. One of my favorite companies for a long time, but I have never invested in them, disclosure. And I find that their business is going through quite turbulent times at the moment. Its share price for the last 5 years actually dropped close to 30%, and it seems to be a good opportunity right now for us to investigate to see what went wrong with Nike and if it has what it takes to turn around the company and make it great again, right? And so today, let's jump into the presentation. If you guys can hear me well, or if I'm not sounding very well, do let me know, and let's get started. So Nike, is the king dead? As usual, this is just information session, and I myself is a wealth advisor with iFast Global Market, and what I'm showing here today is my own research, and it doesn't in any capacity represents the view of iFast or my colleague, right? So do bear that in mind and treat this as just an information session, and I hope you do your own research if you are investing. And welcome everyone to my Premium Club webinar. And we have been doing this for more than a year now, at webinar 26, so just slightly over a year. And we started this last year, and every 2 weeks, I'll be giving a webinar to share more about my analysis on either stocks or ETF or even funds out there that is interesting to me, or I'll be talking about some of my investment philosophy and strategy, and hope that you can use it on your own personal portfolio. And as I mentioned, I am a wealth advisor with iFast Global Market in Malaysia, and iFast Global Market is of course part of the iFast Group, listed company in Singapore. And we are basically a wealth platform that allows you to gain access to almost all possible investment asset that you might need to create a diversified portfolio. And of course, for myself, if you're new to me, I hope you're not that new to me, but I have been sharing my views on YouTube and on my website for quite a long time now. And I tend to have a very straightforward philosophy when it comes to investing. I'm a long-term investor. I don't really trade for the short term. I focus on very, very long-term macro trends. I always believe that portfolio should be focusing on risk management. So I'm always focusing on high quality companies that I don't mind holding for a long time, and I can sleep soundly at night. And I don't try to time the market, and I just go with the flow of the market. And typically, over the long term, the market tends to appreciate as businesses do better and better over time. So what I'm really trying to do now, and also for some of my clients, if their strategy gels well with mine, is to create something what I call an everlasting portfolio. So a portfolio where we can start small, it's okay, but the strategy doesn't really change that much. As the asset size grow, it can be something that we're scalable. Even as it grows to a big portion, we can still be comfortable investing in the stock market through this strategy. And of course, if you're a Premium Club member, I also share with you my ETF Plus portfolio, where I'll update you guys every quarter. Okay, and what I'm really trying to do is to share that what has worked for me in terms of building up my portfolio and also creating wealth over the long term. I'm trying to share that with my knowledge with my clients, and also hope to improve and see where are they facing struggles with, and help to improve their portfolio management overall, to create true long-term wealth in the future for them, right? I use tons of tools, and typically very tech focused. This is a example of my financial planning tool that I use quite systematically with my clients to simulate any life scenario or life goal that they have, to simulate out to show them what they're doing now. Is it on the right track? Would they face any shortfall in the future, and how we can remedy that in the future, right? So if there's something that could interest you as well, and you want to go through this journey with me to see if you want to have a better peace of mind to see that your financial health is still on track, you can always join the wait list here. I'm still working with roughly close to 6 or 7 clients right now to run through this health check. So do bear in mind that it might take a little bit of time for me to work through the list, but if you're interested, you can always join the wait list first, or you can just email or WhatsApp me directly, and I'll put you on the list. And when I have time free up, I'll definitely reach out to you to see how I can be of help, right? But today, let's dive right into the main topic, which is Nike Inc. And Nike is a very, very fascinating company. The first time that I truly appreciate how long it has come is by reading the book by Phil Knight's Shoe Dog. It explains his journey on creating Nike from its founding all the way to how they are more stabilized and become a global company. So that really gave me appreciation of the journey of Nike and what they have really created. Although you can see that nowadays there are more and more competition in the sportswear and sports shoes arena, but Nike till today, even after all the trouble it has faced over the last few years, it is still the undisputed king of sports, even today. So we're gonna talk about the history of Nike first, and then where the huge mega growth is coming, right? AKA Jordan era. We're gonna talk about the outsider, what really happens during the COVID pandemic, the new CEO, what went wrong, and now with a new CEO that has been with the company for many years, an old veteran return to lead the company. Does it have what it takes to bring the company back to its glory days? Okay, so starting the year is 1967, and Nike is founded by these two gentlemen, Bill Bodeman and Phil Knight. They are actually sort of a coach and athlete relationship. So Phil Knight was a track and field athlete, and Bill Bodeman was his coach, right? And Bill Bodeman, you can say that he is really the heart of the organization at the beginning. He is the Steve Wozniak of Nike, right? He's the one that is researching and trying to find ways to improve the products that is already out there in the market, right? He don't really like the spikes shoes that for tracks and field athletes. He's always experimenting to see how he can do things better. And at the beginning, before he founded his iconic wafer sole, Phil Knight actually went to Japan to talk to this company called Onitsuka Tiger to distribute their products in the US. And that's how the genesis of the company started. And they named it Blue Ribbon Sports, right? It was not Nike yet, and it's basically a distributor. And Phil Knight went through a lot of trouble, right? That was before the era of internet, so he literally had to fly to Japan, has to beg the back Onitsuka Tigers to, management to see him, and then convince them that he could move the product in the US. And the story was, it took a long time before they even meet with him, and basically they wanted to have no risk at all. So they wanted him to pay cash for the product even before they sent, and he has to call back and beg his father for a loan to wire the purchase amount for the first batch of the shoes. And you can see, the shoes, even until today, if you know the brand Onitsuka Tigers, it's very, very similar. The shoe that they are selling now is still very, very similar to the original Nike that they are selling right in 1960s. And what happened later is almost a classic event that the distributor and the principal tend to have over time, especially when the distributor has bigger ambition to be just a distributor, right? Phil Knight at the beginning, he has very, very big ambition, and he really wanted independence from being a distributor and being held hostage by Onitsuka Tigers. So he always wanted to create his own brand. And of course, they started distributing in 1967. Business is doing all right. They are able to grow volume. But by 1971, Bill Bonderman has sort of unveiled his own creation, and they wanted to sell their own shoes. And they brand the shoes as Nike, with the very iconic wafer sole. So if you Google it, you'll be able to see the wafer sole of the first Nike. And the idea is it allows track and field runners to feel more comfort and at the same time perform better. So but with them now having their own brand, it sort of soured the relationship between Onitsuka Tigers. And Onitsuka Tigers wanted to buy them over and only see them as a distributor. That didn't happen. It deteriorated the relationship even further because Phil Knight saw it as a hostile takeover, right? There's no discussion, and they're trying to destroy his business. So they sort of went to war. They have a long legal battle, but in the end, actually Nike won. And Onitsuka Tiger was not able to take over the company and was not able to stop the company from selling Nike. But the split has been the seed of splitting up has been buried. So that's where Nike really started out and wanted to create their own brand rather than being just a distributor for Onitsuka Tigers. And they went on to be very, very focused on producing track and field shoes for the next decade or two, right? They grew their business. By the time in 1984, their business grew to around $60+ million a year. A pretty good sum, but you wouldn't consider them a very, very big company, right? At that time, the big shoe companies are still Converse, Adidas. Those are still the benchmark of the shoe world. Nike was very, very much still a very track and field focused company. You can maybe consider them as the current day of maybe Oka or On's running. So a product that is still very, very niche and only in one particular sports. But here in 1984, a new superstar was born. Michael Jordan was drafted into the NBA, and he was looking for a sponsor. He actually wanted to go with Converse, and that's all where the basketball players are wearing. And and he wanted to do that as well. But the story goes that his mother forced him to come to the meeting with Nike, and they were able to convince him by creating an iconic Jordan shoe for him in particular. And this was at the time where Jordan is just a rookie, right? It's just in his first year. And the deal was he will have his own name shoes. And so basically, Nike put a very, very big bet on Jordan itself. And they have projection that this shoe should be able to sell. It's their first foray into another sports, into the NBA. And they project maybe they can sell for a year about 3 million in sales from the shoe. But what happened is within the first 30 days, they have blown past their yearly targets. And by the end of the year, the entire company revenue blew to around 125 million. So doubled the company revenue from before, just by signing Jordan. And that really exceed all expectation, and really opened the door for Nike into another sport, which is basketball. And from then on, they really take onto this key idea of finding superstars, sponsoring them, and using their influence to sell shoes. They did it again and again, and from basketball, they expand to many other sports. And today, Nike is the largest sports sponsors for almost all the sports out there. And the company last year has about close to 50 billion in revenue. And the Jordan brand itself is about 6.59 billion in revenue. So even until today, the Jordan brand is about 13% of Nike sales. Still a very, very strong brand, and it really redefined sports sponsorship. And Jordan is a pioneer with Nike in creating iconic shoes or apparels that is named after the athlete. So all the way from 1985 to around 2000s, they have some hiccup along the way, but basically their strategy is world dominance and expands to all the other sports as well. So they've been growing almost every year for the past 20 years. Let us fast forward to the year 2000. And that is, the year 2020. Sorry about that, right? The year 2020, enter John Donahue. And of course, COVID as well. So it's at the same time, you can say that it's the timing was quite significant, because the history of John Donahue is that he is actually not a shoe guy or a retail guy. He's just the second CEO that is appointed to the company from outside Nike. So Nike has always replaced the CEO with internal CEO. The first time was in 2004 when Phil Knight retires, and they hired a CEO from outside, from Johnson and Sons. That CEO also lasted only 2 years, and it wasn't a good fit, and they chose someone from internal, which continued to Mark Parker, which continued to lead the company for more than a decade. And then came the second outsider, John Donahue, to replace Mr. Parker. And in 2020, John Donahue was actually previously was the CEO of ServiceNow, one of the fastest growing software company. And before that, he was CEO of eBay, and he has been in many tech company. And he started his career with none other than Bain and Company, a consultant. So he's a very unlikely candidate to be CEO, but it was also coming at a very, very unique time during COVID, the start of COVID, that Nike has to do a lot of its sales through online channel, and maybe he's the right guy to help them do that transition to become more of a tech company. So during his period, he oversaw a lot of changes in Nike, trying to revamp company to not be a shoe company anymore, to be a tech company. And some of the things that he did at the beginning, it was pretty well accepted by the market. So he feel that they should shift more of the focus from wholesale partners, their distributors, to Nike own sales channel. So they wanted to be selling their shoes more of a direct to consumer method. And that strategy actually thrived during COVID because everyone is stuck at home. And if you want to buy a shoe, maybe you just go to Nike.com or have the Nike app to purchase your products. So initially, it was well received, and Nike share price actually surged during his leadership. And then the company also showed that it was not too impacted by the pandemic, and sales actually grew after the initial shock. So the market cap actually reached some of its the highest peak point during John Donahue tenure. The company went to close to a 300 billion market cap by November 2021. However, he also embarked in things that are not so popular. He embarked on a cost-cutting spree that he want to cut about 2 billion in costs, and he also laid off 2% or more of the workforce. That was not well received from within the company, and also later on within investors as well. He also changed the focus of focusing not too much on the sports technology aspect of his product, but rather having a consumer experience or becoming a lifestyle brand a little bit more. He released a few more products, including the Panda Dunk, aimed not at the sports consumer, but rather more of the casual wear consumer. And it was a hit at the beginning, but I guess he just wanted to milk it more and more. And there's a lot of variations and a lot of new release constantly, and that led to some saturation in its product and also fatigue from consumer with too many choices. And all this came down at a crash when we started reopening for COVID. So you can see that this is when he took over right at the beginning of COVID. This was when all the investors was feeling optimistic from all the changes that he has made of making Nike into a sports company, into a tech company, but that was quite short-lived. And when things started to reopen, the problem starts to surface out. For one, he alienated a lot of his distributors, right? He cut back on sales to retailers that has worked with Nike for a long time. The Urban Outfitters, Macy's, Foot Lockers. So all these distributors who has very, very long-term relationship with Nike felt slighted, especially in the time during the pandemic, right? Nike was not there to support them. Nike cut them out and trying to jump over them and go direct to the consumer. That's almost a sign of betrayal, right? In such a volatile time. And all the digital transformation more or less also fell a little bit flat when things came back to normal and people start having a normal life again. And so at the third quarter of 2024, he was replaced, and he he has to ride into the retirement sunset. But don't feel too sad for him, because from it, his dismissal fee was around 32 million, right? So for 3.5 years of work, pretty all right for him, I would say. But I wanted to spend a little bit of time with you guys on thinking about this question. Is it really all John Donahue's fault, right? The media or maybe even the board try to angle it in the way that it is all his fault, that he bring the company to such a situation. But I wonder, is it really all his fault? But I think a lot of it actually comes down to just the unusual time that he has his tenure in during the COVID pandemic. And him himself being in the tech background, maybe he's more used to much fast iteration and fast changes within a company. And he tried to do all these things all at once, within a 1-2 year span. He introduced everything and wanted to transform the company quite drastically. But for a company like Nike, which is still pretty much, you would say, a traditional company, a brick and mortar type of company, a retailer and a brand, maybe they move things a little bit slower. Maybe they're more like Johnson & Johnson or P&G, right? And such huge drastic change is a huge cultural difference. Some of the things that he did during the pandemic, you could argue that that's the only logical option, right? To move to more direct to consumer, to boost up his technology app and also website so that they can handle the volume, improving the ERP system so that they can be more online focused. I would say that in theory it works. It seems to be on the right track, but maybe just the implementation of it is a little bit not sensitive to the company culture, and that's where it has a lot of backslash and didn't have the buy-in from within the company. But worry not, now the old guard is back. The new CEO from September 2024 came back, Alex Hill, and Mr. Hill is actually a seasoned Nike veteran. He has interned for the company since 1988, and he has worked for the company for 32 years. For 32 years from across Europe and North America. And he is one of the influential people that has helped Nike grow during its mega growth period. But he retired in 2020, just when John Donahue becomes CEO, right? I don't know why, but maybe he expected that he could be the CEO. That's just my own guess. But he retired in 2020. But now he's back. And he has already done a lot of media appearance and also reassuring investors and his employee that he is going to bring back the old spirit of Nike and what is that entails. So it comes down to 4 key things. He wanted to reestablish a very sports obsessed culture of the company. That means that he feel that last few years the company has strayed a lot from focusing on the sports, and he wanted to reestablish that connection of the strong connection that Nike always have with its sports star, right? So he has been meeting with a lot of their key sponsored stars, looking for ideas, looking for collaboration, and especially doing a lot of storytelling of the story of this athlete to create back that journey of a sports athlete, that journey of excellence and perseverance that Nike always embodies. Number 2 is he wanted to re-energize the product innovation, meaning that more focus will be put back into R&D, creating sportswear that are more innovative and could be different. Hopefully that works. And because especially now with more and more competition, there are quite a lot of new innovation in different sports, and it could be more of a challenge for them to really stand out. Number three is more of a marketing message to focus more on back on some of the old technique that Nike always have of marketing by focusing on the story of the athlete. And if you look back on, I would say the 90s, the 90s Nike ads, they are pretty focused on the athlete and tell a story from the athlete, and we can feel the journey and the perseverance of the athlete. I guess he wanted to bring that back and more storytelling within the advertising. And lastly is to rebuild the wholesale relationship with its distributors. The aggressive push to direct to consumer over the past few years, like I said, has really alienated a lot of his wholesalers. And so he has a tough job, I think, on this one, especially now with so many other competition already coming in. Nike has to show its sincerity to gain back all the shelf space that it has given up for such a long time, and especially during very critical time during the COVID pandemic, and how they might have to get a deal back into the shelf space. Maybe in the beginning, they have to be at the losing side a little bit just to regain back the trust of all these wholesalers. That could be a possibility. But interestingly, if we look through even during all these troubled times from 2020 to all the way to now, you can see that its revenue is actually still growing, right? Even with all the misstep of the company, the revenue is still growing. It peaked its profit in 2021, and its margin has been declining. So there's a little bit of work here to regain back the profit margin that they used to have, and also regain back the growth that they used to enjoy. But is Nike a company that is just a simple company, or do you think that the company has a particular moat? What I feel that they do have a certain amount of moat, not really in its brand name, right? It is the largest sports brand in the world. But if I go to a store today, being JD or JD Sports or Sports Direct, if I am choosing for a shoe, I wouldn't purposely say that I must have a Nike, right? I don't mind choosing across the brands. But I think what Nike has, and the moat that it really has, is the significant link between the brand and all its sponsored stars. And Nike has the deepest pocket to sponsor a huge range and huge number of stars all over the world. So I think that is the core moat of Nike, that with its strong sponsorship of so many athletes that we aspire to be, we are interested and invested in their game and in their life. That's where the moat is for Nike, if they can continue to have that relationship with all these sports stars. And for now, at least, they still have the majority of the big sports stars in the world. So if we do a quick SWOT analysis on the company, I would say that the strength of the company would still be its strong relationship with all its sports stars. And of course, it has the best distribution globally, supply chain, and also maybe even some of the technology, both in the sports and also in e-commerce. that they have built up over the years. Some of the weakness, I feel maybe at this point, internally the company morale might not be very strong. It could take some time to regain, and they have actually lost a lot of market share in many key market, especially when we look at running, which is predominantly has been dominated by Nike for a long time. But in the past few years, we've seen so many running companies, running sports shoes company, gaining market share as Nike gone through these turbulent times. There's now so many brands, be it your ASIC, ONS, your Oka. So it might be more competition for them to come back to where they are before. And so with social media and with more and more influencer, be it sports influencer or just the channel that can reach the consumer is so wide now, with so many individual sports stars. It's easier and easier for new people to create new brands, for company to create new brands, and maybe the time of like a one giant sports brand to conquer everything, it's over. Maybe we're looking at a more fragmented market in the future, just because of the barrier of entry is so much easier now. That could happen, right? That's a threat. But there's also an opportunity. The company at this point, it's at, you could argue, is at one of its lowest point. And if it could just go back to its norm, it's still going to be a pretty good turnaround story. And sports culture still continue to be on the rise. People are more and more interested in their health, in sports, and that could be an opportunity for the company. So if we look at the financials, what I found is, just now we shared that the revenue has been growing very slowly, but still profitable, and more importantly, is still free cash flow positive. Margin, even after declining for a few years, is still pretty decent, right? The operating margin is around 30%. That's fantastic for apparel and sportswear company. And what's important is, what I always like to look for companies that has very, very low debt. And Nike is actually in a net cash position. They do have some debt, but they are sitting on like $12 billion in cash. So more than enough to cover their debt obligation. They are always, they're still free cash flow positive, and they have been using excess free cash flow to buy back a lot of shares. So this company is doing both. They are also giving a dividend. The dividend yield is around 2%. Plus, they're also buying back a lot of shares. They still have a 18 billion share buyback program. They're still running. And they are buying back around 3%, 3 to 4% of their outstanding shares every single year. So in terms of yield, the company is already giving close to like 4 or 5% in yield, both in dividends and also share buybacks. That's pretty good, even if we just see it as a dividend counter. So I extracted some of the information from our platform, and you can see that Nike is now trading at close to around 21, 22 times PE, and its price to sales is around 2 times. And if you look through some of its competitor, apart from say Adidas, what else, or Skechers, which is I wouldn't put them on the same league. I guess the Adidas is the only one. They're still doing pretty all right, and the valuation is quite similar. But I would say that Nike is actually in a much better shape than Adidas. Adidas has gone through even more volatile years. Its revenue is even declining, and its profit is dwindling, almost reaching the point of at the loss. So if we look at companies, how has all these sports company done over the past few years? Nike, we saw just now, right? Revenue grows slightly, but profit not really growing, quite flat. Adidas actually saw revenue declining slightly, and the profit has plummeted. That's why its PE is so high, because the earnings is almost all gone. Under Armour is also not doing that well. Under Armour is also went into loss territory. But there are other companies that are doing pretty well. ONS is doing pretty well, growing very fast. ASIC for the past few years has doubled their revenue and profit as well. So it's growing very, very fast, which is why you can see that their valuation is much higher as well. ASIC, fun fact, is the company behind Onitsuka Tigers as well. So the old nemesis of Nike is still around. They have been renamed, and they are basically ASICS Corp right now. Right? So that's one fun fact for you guys. And what else? A company that we talk about, Lululemon. Lululemon is doing fantastic, and it's one of the still growing very fast, and profit also improving. And I would say that if you have missed out on our Lululemon episode, which is on webinar number 13, you can check it out again. I feel the story of Lululemon is still intact, and they are basically going through the same playbook as Nike. Nike was a track and field brand, and with Jordan, and they found the confidence to expand to many other sports as well. And Lululemon is basically taking that same playbook. They are a very focused yoga brand, and from there they have now expanded into other sports as well, and going on a global expansion path. So I would say that if history repeats, Lululemon could be in for pretty interesting time ahead, right? Okay. Anyway, sidetrack a little bit. Let's go back to the key takeaway here. The key takeaway here for Nike is really seeing that the company, yes, has went through a lot of turbulent times. I would say that not all the fault is with the previous CEO, John Donahue. He has done some of the things actually pretty right, and maybe just that the timing is a little wrong, and he is a little bit insensitive to the culture of the company and trying to do too many things all at once. But the story of Nike and the culture of Nike is still pretty much intact. It's still a brand that is very visible, and everybody knows about it. It is still a company that people are passionate about. If you work there, you'll be pretty passionate about the company. And now with the old guard, Elliot Hill, they should come back and go back to basic. And I think the chances of them to turn around is pretty high. And with the good financial strength that they are in, and the strong free cash flow that they're producing, even for us, if we are investing in terms that in a bet that they could turn around, even if they take a long time to turn around, we are still enjoying quite decent yield, about 4-5% yield from the company itself, just from its cash flow. Having said that, I would just put a caveat, right? I myself have not invested in Nike, but it is truly a company that is in my watch list, and I'm thinking about it. I might, but typically, even if I do invest in companies now, I don't really have a very large position anymore, because most of my large position is more taken out. So more or less, I'm only buying quite small position nowadays. So this is a company I'm definitely looking at. Same as for Lululemon. But having said that, there's still risk with a stock like this. Because if we look back at something that happened similarly, which is the Chinese sportswear companies, your Li-Ning, your Anta, your 361 X-Tab, on the in the 2000s, they have a huge majestic rise, right? And all the way until the Beijing Olympic in 2008, they are on track, right? They seems to be on track to overthrow Nike and Adidas, at least internally within China. But that all came down to none by 2008. And one of the key issue is they have been over ambitious, and that leads to inventory glut, where they have so much inventory within all of them that at one point they were having buy one free one promotions, and on top of that, buy one free one, or buy one, then they will donate one to the rural area of China, and things like that, just to clear the inventory. And even with that, it took about 10 years for all this sportswear company in China to stabilize. And now we can see them coming back again in strength, right? That was 2008 when it happens, and now it's 2025. So see how long that turnaround could take, right? So I'm not saying that Nike could take that long, but a turnaround, just because we feel that a turnaround is coming, doesn't mean that the turnaround will happen straight away, right? So that's a caveat there for you guys. And that's the key takeaway I have for Nike on today. I hope you enjoyed that. And if you have any question, especially for my Premium Club members on Zoom, just open up the chat box, and we could have a Q&A. But while you are doing up your Q&A, as always, our spin-off section, this is something that is not related to our topic, but it's something that I have been going through over the past few weeks, and I find it interesting. I wanted to share with you guys, which is this book called The Davis Dynasty. It's a book I read a couple of years ago, but I'm just kind of rereading it to refresh my memory. Sometimes a lot of books that I read, then after a while I actually forgot what is it about. So I tend to at least have a quick reread on them to understand where are the key points. But this is basically a story of a billionaire company. And the Davis Senior, the first Davis, started out investing with just $50,000 in 1947. And by the time he passed on, and many generations later, I think one to the third by the third generation, that turned into $900 million. So, but the key of the story is not really, him passing the money to the children, but rather I think the greatest gift that he passed on to the next generation is not the money, but rather the mentality of money. They teach them about the game of money and understand how money works, so that each generation could then compound their wealth over and over again. But it also shines a little bit of light into the family dynamics, and their relationship has been very, very tense because of the strict philosophy that Davis has, that he has to be so frugal. Even when he's a billionaire, he is still so frugal, and he forced that frugality onto all his children and grandchildren, until that it becomes a big strain, right? And that wealth that wealth is no longer something that is to be desired, because that wealth, you can see it, but you can never spend it. And it becomes a point where that wealth become a prison for the family, right? and it comes around. I think that's why this story is quite beautiful. It comes around to, at least for me, to question, is money really all that is? And it boils back to a story that I recently have a discussion with my wife, that I was sharing with her, the story of Charlie Munger and Warren Buffett. And if you guys have heard me say this before, the person that I truly admire is more so Charlie Munger than Warren Buffett. And the key difference between them, I was explaining to my wife, is that Warren Buffett is very similar to Davis. He's very, very frugal. His daughter wanted to renovate her home, and he basically rejected the daughter and asked the daughter, just go and get a loan yourself to renovate your house. Whereas Munger was never that. He was always open to sharing that wealth with his children and his grandchildren, and he talked about that before. And he would don't mind to have them fly first class or private jet because he could, and he said that that's the only way, because if not, they will end up resenting you because you have the wealth to reduce their burden, but yet you do nothing, right? And that's the key lesson there. At what point there must be a balance, right? You can be chasing after wealth, yes. You can be as frugal as Buffett, as Davis, but to each his own, right? All of us, and for our family, there must be a balance point. And you have to think about where is that balance point. What do you want to give up to have that balance? And for Munger and Buffett, I think it's a very, very clear example on both of them to see the trade-off of making that choice. Because Munger, by the time he passed, he was worth around $2 billion, thereabout, right? His entire wealth, he was worth about $2 billion. And Buffett, if he has not given away so much of his wealth, today he could be worth well more of $200 billion, right? And that's really the cost. Both of them are equally good as an investor. Both of them are of very similar age and has been investing for a very similar period. And the difference, right? The difference is one person don't mind spending the wealth, one person just hold the wealth to compound over and over and over again. And that difference is 100 times of compounding over a lifetime. And we have to ask the question, is it worth the trade-off? Should we make that trade-off? So that's an interesting story to end right there. And just want to share some of my thoughts about investing and about life. But like I said before, right at the beginning, my philosophy is very, very simple, that I treat my portfolio more of a way to park my wealth, more of a way I see myself as a collector of great companies. And so I have a very long-term view and hope that I make good choices on that long-term opportunity. And I always focus on quality. I don't trade. And if the company is trading very, very cheaply, but it's not a good company, I'm more than happy to give it a pass. And I try to be a contrarian, meaning that I try not to time the market, and I just focus on investing for the long term to build my everlasting portfolio. And that's what I wanted to do and help with my clients as well, with my work here with iFast Global Market as well. And I have been very fortunate to work with a few clients, and also with this platform that allows me to have access to so many asset classes, to be able to carve and design portfolio that is worthwhile and unique and also useful for my clients as well, right? So of course, again, if you're interested in that, to speak with me one-on-one, feel free to join the wait list, or at least reach out to me through my WhatsApp or email, so that to indicate your interest in that as well. Okay, before we go into the Q&A, I'll just end before I start the Q&A with a little quote, which I always talk about. I always end with some quote at the end of the webinar. And this one, I can't really find who has said it in particular, but I have seen a few person reference it before. Jordan Peterson as well, and a few others, where they talk about in life, especially in terms of teaching how to teach our kids. But he put it in a way that is teaching our kids, but I think it applies to everything we do as well, right? And I feel that the key to life is not really to avoid risk, but learning to do dangerous things carefully. And I hope to end that with you guys as well, right? So I can go to the question first. And SJ, nice to see you. And I'll read out the question for those on YouTube. He's asking, how undervalued is Nike in terms of PE and possibly price to cash flow? So typically, I don't really use price to cash flow, just because the cash flow is quite volatile. It's not very stable, right? So I don't really use that. But for a company like Nike, where their earnings is quite similar to the earnings is quite a real representation of their business. I don't mind just using the PE or using price to sales actually as well. So just to give you some data, the price to earnings of Nike for the past 5 years has typically ranged around 35, and the current is around 21, 22. The price to sales of Nike is the history average is about 3.8. Price to sales now is about 2 times, and that goes way back to the early 2010, 2012. The price to sales is typically is above 3 for most of the time, and the price to earnings is typically more than 30 times for most of the time. So you could argue now is at a very low base, but of course for the last 20 years has been in the low interest rate environment, and now is considered a not really high, but a medium interest rate environment. So does it warrant that the valuation should come down, right? Yes, maybe, but the entire market has not come down. So in terms of now compared to the market, I would say, Nike is quite considered to be quite cheap at the moment. Yeah, hope they answer that question for you. And all right, I hope you guys enjoy this session. It has been a blast for me to research on this company, and I really enjoy it. So thank you so much for all of your time. I hope you have a great week ahead. And if you are a Premium Club member, we can continue this discussion on our Facebook group as well. So thank you once again. My name is Stanley from iFast Global Market. If you need to speak with me one-on-one, do reach out to me. You can reach me at learnwithstanley.com. I have all my contact details on that website. So thank you very much, and have a good night. Till we meet again, invest safely.